Hey, what's up, guys? Justin here with Confident Options. Tonight is Sunday, September 30th, final day of September. Hope you guys had a fantastic week last week. I know we did. Lots going on in business, lots going on personally. It was my birthday yesterday, so great week overall. I'm happy to be back here and into this video for last week's review and getting ready for next week, first week of October. So let's jump on into it. I'm over at the website. We're going to go to close trades. So this week we had 7 closing trades, 6 winners and 1 loser. Typically seems to be our kind of mantra, I guess. Each week we have, 6, 7, 8 winners, and then it's typically 1 to 2 losers or scratch trades, which jives with all the metrics that we produce on the website. We hit about 80-85% winning rate total. But if you dive into different strategies, strangles would be at about 90%, iron butterflies would be about 68%. But that makes sense based on the probabilities that we're trading. So just good proof that long term the numbers really do work out. So keep after it. If you're struggling, let us know. We're here to help any way we can. So like I mentioned, 7 closing trades, and I'm going to go back down in time here to the first closing trade of the week, which was our position in EEM, and we're actually going to start there. We're going to review 4 of the 7 closed trades. A couple of them had some adjustments and rolls, so I think they're good to go through. And then, of course, we'll go through the 1 loss. And so let's get started. EEM has been up there with the implied volatility. It's I think it's an emerging market or Mexico or somewhere in South America, and so it's along the same lines as like the EWZs and the other one. So it creates opportunity for us. A lot of people, I guess, sometimes get scared when stocks start moving making large moves. But for us, that means good things. That means IV's high. That means premium's elevated. That means we can really sink our teeth into some of these trades. So let's go through this one. In EEM, we had the iron butterfly. Technically speaking, we had a really tight strangle because our short strikes were not the same. If our short strikes were the same, it would have been an iron butterfly, but I'll tell you why I'm calling it an iron butterfly here in a moment. But it was a really tight strangle with wide outside wings. So we sold the 42 calls and 41 puts, and then went out further and bought protection. So 46 call and 37 put. To be completely technically correct, this is an iron condor because it has the long strikes too, but getting away from that, let's just jump over into the charts. So we opened this trade up on August 15th, and we did end up having a roll through our cycle. I'm starting to mark these on the chart. That way I just have some context too of making sure I'm not over trading these things. And visually I like to be able to see kind of what I'm doing. So we opened the trade after a lower move here, and we opened the 42 calls and 41 puts. So again, it's pretty tight, right around the stock. So 42 calls and 41 puts. So our calls are always on the top side, our puts are on the bottom side. So you can see how the stock was trading right in between. And so to get as neutral as possible, instead of selling 2 of the 42 calls, or a 42 call and a 42 put, or going the other way in a 41 call and 41 put, we decided to be as neutral as possible, so we just sold around it. So that was our opening. Oh, well, we also bought the outside wings, so these were our long strikes up here. I'm not going to pay too much close attention to those. I'm actually going to just take that off so we can look at the core premium position. So what happened is the stock moved directly against us, and so on 827, which is this marker here, we decided to move our puts up from 41 to 42. So that actually did end up making an iron butterfly. So now we have calls and puts at the 42. So now we're nice and balanced. We took in some more premium. So on that move up, we collected another 10 cents. So we collected $1.51 to start with, and then we collected another 10 cents. And then we decided on this date here, which is 8/27. Actually, let's check that date. I'm sorry. Make sure I'm being correct here. So that's 8/31. We actually decided to roll the position out. So that's this date here. We rolled the position from September to October, and we took in another 50 cents. So all we did was pick up the same exact strikes, both the short strikes at 42 and then our long calls at 46 and our long puts at 37. We took both of those, all that position, and closed it and then opened it in the next contract cycle. That allows us to extend duration and also collect additional premium. So we did collect another 50 cents on that. After that point, we were decided to just go ahead and let the stock do what it was going to do. So it moved down, moved up, moved back up. Essentially, it was closed about the same point that we did our roll at, but the decay in the time premium, the decay in the premium really helped out here. So it came in nicely for us, and we were able to close it out for $1.75. So the original collection was $1.51. Collected another 50 cents up here, or 10 cents up here, 50 cents here. So our total credit that we ended up taking into this point right here was $2.11. And so those are the only credits that we took in. And so over here, we were able to close it for $1.75. Not exactly our profit target, but you have to be opportunistic, especially when it starts making these gapping moves up, moves down, comes back down. We go ahead and close it off where we can with a profit and kind of move on from there. So successful trade. I liked the management, maybe a little bit of over management up front, but hindsight's always better than looking forward. So if you were to trade 8 contracts on that position, it would have been about $300. We are usually at the bottom of this scale. Just so you guys know, we trade very small and we trade very often. So you'll notice that we're consistently closing 7, 8, 9, 10 trades a week, which means you have to have those trades working for a while. Typically, our trades work for about 20 days. And so you got to keep filling up the hopper. You got to keep putting on trades. And so what we do is we typically trade at the low end of this, just because we like to trade a lot more. So actually this position was a good example. We only traded 2 contracts. So it ended up being a $72 profit for us. Nice small little winner, but we take it and we move on. All right, next trade we're going to look at is PCG. PCG is actually one I hadn't traded before, so it was cool to see it come up on the radar. It was popping up in the implied volatility rank. I believe it's in the utility sector, so it's really hard to get utility stocks to actually have a lot of implied volatility. So when we saw it, we thought it was a good opportunity. We were able to collect $1 for the strangle, over $1. So that's usually our floor. We always want to try to trade more than $1. But it turned out to be a really nice trade. So what we did, we opened up the 50.37. We made an adjustment sort of mid-trade where we moved the puts up from 37. So we went ahead and closed these and opened these. So then we have the 50.43. And then we went out and closed the 50 and the 43 come 9.24. And we actually hit 50% target exactly. So nice big return on capital. It didn't take much to put on the trade. So it made a nice win for us. So let's look at the charts really quick. So again, I'm starting to add these arrows. Hopefully you find that helpful. So we went ahead and entered the trade here. So this was trade entry, and we sold the 50 calls. So all the way up here, and we sold the 37 puts down below our screen. It doesn't ever breach those, so we'll just let those be. Okay, call and put. So let's get you kind of some idea of where we're at, what we're looking at. The stock immediately moved against us. It's funny how this happens. Big strong day the next day, gapped up the next day, kind of hung out there for a little bit, gapped up again, and it kind of sold off. But what we ended up doing on this day here, which I believe was the 4th of September, we moved our 37 calls, we closed them out, we locked in the profit, and we moved them up to 43. So that's going to be right in between here. And we were able to collect another 50 cents, I believe, 53 cents. So 43 puts on the bottom side. So now we have, pretty tight range, but we've collected a ton of premium at this point. We've collected over $1.60, actually right at $1.60. So that gives us nice wide range, so we can go $1.60 above here, and we can go $1.60 below our 43 puts. The stock really did nothing, which is exactly what we wanted to do. It kind of just drifted here, drifted a little bit higher. Went ahead and closed it out on that down day there, right at our target. So we ended up collecting a total of $1.60 on the premium side, and we closed it out for 80 cents. So kind of picture perfect, exactly what our target is. Nice patience. IV kind of sold off, or actually contracted. Sold off is not the correct term. So you can see where we entered the trade was about here, and where we ended the trade, it was about here. So we had a nice kind of down move there, above 60 to below, to actually right at about 40. So good reduction in volatility, which is exactly what we want to see. So nice little trade for us. Next one's going to be our call credit spread. You can see we had an EWW strangle, which was a nice winner. And next we're going to be Johnson & Johnson call credit spread. Our indicators were flashing that this one was due for a stall or kind of a reversal, so we went ahead and took on the trade. We sold the 146 call above the market and then went out even further and bought the 148 call. Remember, your goal is to correct 1/3 the width of the strikes, which was exactly what we did, sort of. So there's $2 wide strikes. It means we want to collect about 66 cents on the trade. I don't get hung up on exactly making sure I get 66 cents or I'm not going to take the trade. You miss too many opportunities if you just don't get into the trade. Now, if this was trading for like 40 cents, I probably wouldn't have taken the trade. But since we're at 60 cents, give or take, that's fine. I'm going to take the trade every day. Our indicators are pretty solid for us as long as we have enough time for it to be right. And so ended up only taking 4 days, and it was a relatively cheap trade to put on, so it makes a nice return on capital. So jumping over over to the charts, 146, 148, which I think I marked this one up. Yeah, I did. So we marked this one up and center us up here. All right. Sorry, let me get rid of that. It's annoying me out there. So we actually entered the trade here. This is where we started signaling some reversal or stall. And we sold the 146, which was up here, and then the 148 we bought. So this was short and this was long, and they're both on the call side. So this is how you create a credit spread, and you want to make sure you're collecting 1/3 of the width of the strike. So $2 wide strikes means we want to collect about 66 cents, like I mentioned. Stock continued to rally and against us. It continued to approach our short strikes. However, we just kind of held on. We knew and believed in the cyclicality and the indicators that we use, and so we were able to go ahead and let it just turn over, and we were opportunistic on this big down day here. Premium started to really come out that day, and we took full advantage of it and got out of the trade. So that was that one. Overall, good solid winner for us, so would do it over and over again. Had a nice trade in GDX, really tight strangle, 1918 calls puts, went ahead and closed that one out. Turned out to be the metals have just been getting beat up, and so we've been taking full advantage of all the metals, gold and silver in particular. We had one earnings trade this past week, was KBH, KB Homes. They do not have, and you can read the notes here, they did not have weekly contracts, which is typically out of the norm for us. We decided to give it a shot, and this is why we typically don't trade it if they don't have front weekly contracts, because even though the stock hardly moved, it definitely moved within its range. I think it was 144 was its move when it was expected to move 179, so it was right where it needed to be. If these were weekly contracts, they would have just been crushed. However, since they had time, people had time, it wasn't until October expiration, the premium really didn't come out of them. And so it is what it is. We got in and we got out. Probably wouldn't do it again. We'll stick with the rules that we've put in place there. It's one of the hardest things to do, but it will help you keep you consistent. So the one loss this week was actually a really small loss, which is typically the case. And if you were trading 9 contracts, which is huge, on a condor like this, you would have only lost $45. We were down here at the 3, so it was basically a scratch trade for us. We are going to start anytime it's negative. Anytime it's negative, it gets a loss. Anytime if it was actually 0, then we would say scratch here, and if it's plus $1, we say win here. That kind of keeps our metrics consistent across what we show you here versus our performance and metrics tab. So just keep that in mind. That's not the way we've done it in the past, but we want to be super transparent. It actually brought our win rate down a little bit, but it actually more reflects reality versus us saying we're not going to count any scratch trades if it's between minus 30 and plus 30. So hopefully that makes sense. All right, so in this one, we actually started the trade as a put credit spread. The stock was moving against or lower and lower, and we'll look at the chart here in a moment. But we opened it as a call credit spread or a put credit spread. And the way that you can adjust a put credit spread, you can't really move the strikes around, is to actually add the other side. So you add the call credit spread, making it an iron condor, and so that's why we called it an iron condor here. And then we ended up picking up the position and moving it from September to October. And that takes 2 separate double diagonal orders to do. First, you do the call side, then you do the put side, since you can only do 4 legs at a time. Then we went ahead and closed it on 9.28 for 50 cents. What we ended up collecting on the trade was, sorry, I don't know why I was doing that. We ended up collecting, let me check here, I think 45 cents. Yeah, 45 cents, 30 plus basically 15, yeah, 45 cents. So we only lost 5 cents a contract, which is how we got to the $15 loss on the 3 contract position. So moving to the charts. Our indicators started signaling for us on this day here that the stock was due for a reversal. Just so happens that the stock continued, which happens. It's part of trading. And so what we did on this day here was actually add the call side. So let's mark up some of what we did to begin with. So to begin with, when the stock was trading here, we went ahead and sold the 30 puts and bought the 32. No, bought the 29. Sorry, 29 puts right below it. So this is our put side. Okay, and we collected 30 cents to do it. So, you know, with the strike would be 33 cents. So 30 cents is good. If you collect that, the probabilities work out in your favor that you'll make money over time. So anyway, the stock was moving really strong against us. It actually breached our short strike, which is this one here on this day, which is actually the day that we added the call side. And so instead of doing anything to this side, we just tack on a call side, which we were able to do up here, 33.34. And so this becomes our short call and our long call, which allows us to collect more premium. So it allows you to push your break even points out further on this side. Stock kind of meandered here, gap down big, gap back up into our range, kind of pulled back. On this big down day, we took the entire position and we just moved it forward 1 contract cycle. And it allowed us to collect another penny. We would have done it for a penny debit, a penny credit, or nothing at all. As long as we can continue to extend duration for less than at least a penny debit, we're in good shape. Stock the underlying ended up kind of moving down, moved back up, and then we had a pretty solid day here, which got us into our range, because remember, our range is right here. We have a pretty small range, but it got back into our range here, and so it allowed us to take it off. We went ahead and took it off at 45 cents. We probably could have waited for 50 cents, but on these rolls and these adjustments like this, I'm just looking to get out, basically break even, which is exactly what we did. Get our capital out of the market and move on, open up something different. So that's how that goes, and that was our final trade. So one thing I want to mention before the close here, we did have an earnings trade last week in Bed Bath & Beyond. We sold the 16.5 puts on the bottom side. I don't even remember what we sold on the top side. It didn't matter because it expired worthless. So I want to go through my game plan. This happens. This is going to happen, especially if you trade earnings. So earnings are something that you can make a lot of money, but you just have to know that there's going to be those times that it comes back and gets some of that money back. We're still hugely profitable on earnings. It's by far our most profitable strategy. You just have to be patient and learn how to actually trade these instead of becoming emotional when these things occur. You just got to be mechanical with it. So hang tight with me and I'll show you how we're going to defend this. So we sold the 1650s and we were in 7 contracts. So we sold 7 of the 1650 puts. Stock opened up way down here. It blew out its expected range. I think the expected move was like under $1 or something, and it moved 3 or 4. So it happens, like I said. So what we're going to do is just be mechanical and let the stock do what it's going to do, and we're going to continue to collect premium. Stay tuned, obviously, on next week's closure or next week's video. We'll recap it again, and then once the trade is finally closed, it'll be on the close trade tab of the website that we just looked at. So what we're going to do is we are assigned 1650 puts. So we're holding 700 shares from 1650. Okay, our account is plenty large enough to be able to hold these shares, so I am okay with it. Holding stock is the most inefficient thing compared to trading options. So it is what it is. We have 700 shares long. That's what happens when you hold a short put and you get assigned, or you go through basically expiration. You get shares put to you. That's how you remember it. If you're short a put, you get shares put to you. So we have those shares. What we're doing, our credit into the trade is at about 55 cents. Okay, so if you think about this, I only need the stock to get back up to 16, for me to become break even. If it was at 15.50, I could probably cut my paper loss right now. I haven't realized a loss yet. My paper loss in half. So my paper loss right now is at about $1,100. So what we're going to do is continue to sell calls. So what we're going to do is sell calls above the market. The only reason I'm doing this, IV is still decent. It's not great. It's decent. But the big factor is over the last 2 earnings cycles, it's no secret that this stock is a dog, right? This stock is probably the worst thing ever right now. It's gone from 70 to like nothing. And so just to be completely clear, I'm not bullish on the stock at all. I'm actually don't put labels like that on stocks. I just trade what's there and what's available. And so let me get this zoomed out if I can. Anyway, it's been 70. Here was the last earnings cycle right here. Gap down, came back. Okay. See this? Gap down, came back, kind of went sideways. It's kind of in this range here. We had a big sell-off day, and then we had some green, sold off again, then really pushed higher. The same thing happened in the last cycle too. So here is another earnings trade, our earnings event, gap down, and went up, comes back, stronger. So we see the same thing, comes back, bounces, stronger. Comes back, pulls in, stronger. Starts to close this gap. So it actually did close the gap here, and it closed the gap here. So it seems like when it gets that gap closed, it returns back. It goes the other way. So the reason that we're continuing to sell calls is because I expect some of the same movement. Now, of course, it's not guaranteed that it'll happen, but what this does for us is allows us to continue to collect premium. So if I were to sell the 16 calls, which I'm going to do this 2 weeks out at a time, so I've already sold 7 of the 16 calls, I think, in 2 weeks, 2-week expiration. If the stock closes above that 16 mark in those 2 weeks, my shares will get called away. So my 700 shares will just get called away, and I'll be left with 0 shares, and I'll actually probably be left with a profit because I am in more than 50 cents on the trade. If it doesn't get to 16 in the next 2 weeks, those will expire worthless, and I'll collect all the premium that I sold. So it's about 16 cents per contract. So I'd be collecting a little over $100 to reduce my risk in my paper loss. And then I'll continue to do it again. So in the next cycle, I'll sell the 16 calls again 2 weeks out. All my expectation is that I want the stock to close above 16 at some point. I can continue holding this position as long as I need to. It's not killing us at all. We have plenty of capital in the account. That's why we only put to work 30 to 40% of the capital in the first place. So just keep that in mind. We have the ability to hold it. If you didn't have the ability to hold it, then you're going to want to close it. Get out of it. Try, deploy your capital in another place. So this is exactly what we're going to do, and I hope that it works out for us. Obviously, we'll continue to manage it. We'll continue to review it on the weeklies, and we'll go from there. That's it for this week's video. Hope you guys have a fantastic first week in October. Let us know if you have any questions by going up to the homepage, scrolling down to the bottom of the homepage once this loads up, and just filling out the box at the bottom. Put your name, your email, put your message. We'll get back to you as soon as we possibly can. We've been getting some great messages and questions through this. We'll eventually be launching, hopefully sometime this year, our alert service, as well as some additional training and resources for you guys. Hope you guys have a fantastic week. We'll talk to you later.